Hello and how are you, ladies and gentlemen? My name is Leonard Tongai Mapenda, and I'm going to take you through part E of our mock exam. And as far as part E of our mock exam is concerned, which I believe you have already gone through it, you have been requested to prepare the accusation journal entry for the accusation of Tangana, and this 14 marks was allocated to this part of the required, and you're also going to be given a mark for presentation and logical flow. So as part and parcel of my recording today, I'm going to highlight to you some of the key issues that you are supposed to have noticed during your reading time. Like in this case, you have been told that Tangana acquired 65% of Tangana in Tanzanian company from a controlling shareholders of Tangana with effect from 1 January. So the first port of call that you're supposed to identify, that's 65% that was obtained. Then we have been also told the effective date of control. And in as far as the scenario is concerned, if you can go back a bit, we have been told that the functional currency for planet world is the United States dollars, whereas the functional currency for Tangana, the one that operates in Tanzania, it is the Tanzanian shilling. So you are supposed to identify that we have got two different functional currencies. Then effective date, we have been told, so for the purpose of answering our required, which is an accusation journal, we now know that the accusation really or planet obtained control of this subsidiary on the 1st of July. We have also been told that it is Tangana is listed on Dar es Salaam Stock Exchange on this date. Tangana had share capital of 350 million US dollars, Tanzanian shillings, as well as the retained earnings of 945 million Tanzanian shillings. The purchase price was 820,389,500. But there were certain conditions which were attached to this purchase price. Like the first point, we have been told that it is subject based on profits for the year ended 28 February 2019. Planet paid, so we have got cash consideration which was paid at accusation, and the balance will be payable on the 28th February 2020. So what does this information tell you about? This information tells you that there was an element of deferred consideration in as far as the calculation of our purchase price is concerned. And when is Planet World expected to have settled this deferred consideration? On 28 February 2020. So as part and parcel of your accusation journal, especially when it comes to the computation of the purchase price, what we are expected to see is the discounting effect coming into play. So it's something that we expect that you are supposed to have picked that during your reading time. And in as far as 1 July 2018 to 28 February 2020 is concerned, you can deduce that you have got N is close to 20 months, if I'm not mistaken there. Yes. Then, okay, based on the 2019 audited financial statements of, okay, this price takes account of the fact that the underlying value of the company lies in the intellectual property held by the company and not just its intangible asset. Tangana are leaders in research and development of improved seeds, and they have managed to be innovative and work towards sustainability, management, etc., etc. In as far as this paragraph it is concerned, as per the agreement between Planet and sellers of Tangana, if Tangana's net profit before tax for the year ended 28 February 2019 is less than 50,000, the purchase price will be reduced by 20%. If Tangana's net profit before tax for the year ended 28 February 2020 is less than 65,000, the price is reduced by further 10%. The fair value of the contingent consideration is 275,000 Tanzanian shillings on the acquisition date. So, in as far as the paragraphs that we have gone through so far it is concerned, there are certain aspects that we are supposed to have picked. So, with regards to the purchase price, one, we have been told that the total purchase price, it is 820,389,000, but it consists of one, the cash consideration that was paid on the acquisition date, plus the deferred consideration which the company is expected to settle on the 28th of February 2020. And we have been also given another information, valuable information, about the fair value of the contingent consideration on the acquisition date, which is, so as part and parcel of your reading time, these are some of the issues that we expect you to have picked, so that you never know what the required we ask you about. But had you managed to go through the scenario with an understanding approach, it was going to be very, very easy for you to address this question. And if the conditions of the profits that we've been told is anything to go by, remember, as we always encourage you, that you are not supposed to approach your studies in silo. You are also to ask yourself what could go wrong in as far as auditing it is concerned. If the purchase consideration, if the profit is less than 50,000, then there is a condition which is attached to that. The purchase price is going to be reduced by 20%. I'm sure you are now seeing risk. There is risk that management, from the Tangana's perspective, they might be tempted to manipulate the profits to make sure that Planet World is not going to pay, or to make sure that the purchase price is going to be reduced by 20%. So in other words, this is going to be beneficial to Planet World side, because what it means, they are not going to pay the previous shareholders of Tangana whatever the purchase price they have agreed on the acquisition date. So as part and parcel of your study, please do not read the scenario as if you are reading a novel. Okay, so if you can go on, the draft financial statements of Tangana for 2019 shows the net profit of that included in Tangana. There is okay, we have got an aspect of a related party transaction that has taken place there, but I'm not going to spend a lot of time talking about that. All right. Then we have been also told that Yenest are now auditors of Tangana, and we're also the auditors is from the effective date of control of the financial statement. So we have got also an element of a component audit. So it's something that you are supposed to be in position to deduce during your reading time. And we have been told that the following was satisfactorily carried out by Ernst & Young. The auditing of fair value of assets and liabilities, contingencies and commitments at the acquisition date. It was noted that the land was undervalued by 45,000, and the machinery with a cost of was purchased with a cost of 2,250,000 was purchased on the 1st of March 2015 with a useful life of 15 years, is it? Then the residual value have been also told of 350. Now the fair value is 2.8 at the acquisition date. So what can you deduce from this information? What it means as per our required ITC consent, whereby we have been requested to prepare the acquisition journal of Tangana, we are supposed to have the revaluation of these assets as per acquisition date. And whenever we have got the revaluation, there's also the element of tax implications. So these are some of the issues or some of the items that we expect you to have picked during your reading time. A review of projections and probabilities of reaching profits targets and discounting thereof at acquisitions. These were already carried out by youngsters. The impairment test of goodwill at year end. Market related interest was determined at 9%. So, in as far as this information it is concerned, remember, if you can go back a bit, we have talked about the deferred consideration here. And now we have got the deferred consideration, and now we have been provided with the further information about market related discount. So I'm sure with regard, in as far as this information it is concerned, you are now begin to connecting the dots. In as much as we discourage you to come up with your own requirements, but we are saying as part and parcel of your reading time, these are some of the issues that we are supposed to have deduced from the scenario. Then another very important element here, we've been told about the non-controlling interest is measured at the proportionate share of net assets. Very, very important as well, because they can be measured at fair value. If they are measured at fair value, I think in this case we have been told that this entity, Tangana, is listed. Then the measurement of fair value from that perspective, it was not going to be a problem, because you would simply get that the fair value on the date of acquisition from the stock exchange. Then we have also been told about the capital gains tax, as well as the income tax at 35% in Tanzania. Remember, if you can go back a bit to this statement whereby we have been told that the land was undervalued by 4.5 million, as well as the machinery, which was revalued to 2.8 million. And I have talked about the tax implications that follows from that information. So I'm sure, in as far as this information is concerned, you are now connecting the dots. Then if you can move on a bit to the next slide, whereby we have also been told that Yenes received group instruction from HHCA. An evaluation of Yenes showed that HHCA can rely on their work. No other significant issues were raised to the attention of HHCA except for the sale made to Ferry Farms. Then we have also been given the exchange rates that were prevailing on the 1st of July 2018, as well as the average and the spot rate on the February 2019. So this is the information that you have been given, and I think in as far as all the information that has been provided from the scenario it is concerned, you can deduce that here it's very, very important that we can place a reliance. So you never know whatever the required is going to look like. Either you might be asked an auditing related question or a FINAC related question. So if it is an audit related question, let's say for example you have been requested to prepare the substantive procedures, there is no need for you to go to town talking about or coming up with the substantive with the auditing procedure to determine whether should you place the reliance on the Yenes or not, because this has been already done. So that's part and parcel of the information that you're supposed to have picked during your reading time. So now going back to, so the purpose of my recording today, it is to assist you, ladies and gentlemen, on how we come up with the answers that we have provided with you as part and parcel of our solution. So I'm going to touch on the areas that we think were very difficult. So, at acquisition, the first aspect that you're supposed to have picked is this one. Which rate are you going to use? Are you going to make use of the one at the acquisition date, or the average, or the one at year end? So, in this case, you are going to take the one on the acquisition date. So, more or less, the applicable standards, in as far as this standard is concerned, are IS 21 and IFRS 3 and IFRS 10. So these are part and parcel of the standards that are at stake. So if you find yourself failing to identify the applicable standards, more or less you are going to struggle, or more or less it is going to be a miracle on how you've been positioned to have answered this. So ladies and gentlemen, allow me to quickly go through the solution on how we get to the solution. So I'm going to take you step by step so that you can see how we came up with our solution. And the main purpose of this recording, it is not to go into deeper details on the calculations, but just showing you how you can quickly earn marks in the exams. So in this case, if I were you, how I was going to approach this required was, we have got our Tanzanian shillings here. We have got our rate that we are going to make use of. Then we are going to have total in USD. Then we are going to have our 60%. 60% is it? Yeah. Then we are also going to have our 40% as part and parcel of our NCI. So we have been told that the share capital here, which I'm going to denote with SH. We have been told that our share capital is 350 million. Then, and what rate are we going to make use of? We have agreed that the rate that we are going to make use of is 2.343.97, because this is $1, 1 USD is equivalent to Tanzanian shillings. So from there, we have got also the retained earnings, and our retained earnings is 945 million. From there, what else do we have? We have been told something about land. And land, we have been told that our land was undervalued by 4.5 million. And remember, as I said earlier on, there are also some tax implications that arises from the revaluation of land. And the next question that you're supposed to ask yourself, is land considered to be of capital nature? Yes. Therefore, the tax implication here, or the deferred tax implication we've been told that is at 30%. So you are going to calculate the 30% of 4.5, and you get whatever answer you get, and you subtract it from 4.5. Then secondly, we have been also told about the revaluation of machinery. And with regards to machinery, there are specific items that you're supposed to have picked. So let us go to the next slide where we can do our workings. So we have got our working number 1 of machinery. Okay. So we have been told that this machinery was acquired, okay, the machinery with a cost of The cost of machinery is Tanzanian shillings of 2,550,000 was purchased on the 1st of March 2015. Okay, so we are saying a date of purchase, 1 March 103/2015. Useful life of 15 years. 15 years, or if you can convert this to months, it's 15 times 12, we get 180 months. Okay. And on the date of acquisition, that was 1 July 2019. Let me check here. Am I correct? Yes, 1 July 2018. 1 July 2018. So, from 1 March 2015 to 1 July 2018, how old or how many months is there? In as far as my calculator is concerned, it's about 40 months. But there are different methods that we can use to come up. Because what I'm trying to do, or what I'm seeking to achieve here, it is to calculate the carrying amount on the date of acquisition, so that you can see whether the revaluation was it an upward or a downward. So, for the purpose of calculating the carrying amount here, carrying amount on the date of acquisition, so we are going to calculate the costs. We know we have been given the cost here. So our next part of call is to calculate accumulated depreciation. And remember, as part and parcel of the information that we've been given, we have been also told about the residual value of this machinery, and it was 350K. Okay. So for the purpose of calculating depreciation, we are going to say cost, which is 2,550,000 minus the residual value of 350K, multiply by 40 over 180 months. Let me see, what do you get from there? So it's 2,550,000 minus the residual value of 350 times 40 divided by 180. I'm getting something about 488,889. So this is accumulated depreciation. So remember, our carrying amount, it is equals to cost minus accumulated depreciation, which is 2550,123 minus 488,889. Then if you do our mathematics there, what do we get? 2550,123 minus 488,889. Okay, so we get something about 2,061,000, then 111. So our carrying amount on the acquisition date, that was on 1 July 07 2018, the carrying amount of the machinery in question was 2,061,111, but it was revalued. The revalued amount was 2.8. So what it means, the difference between the two, it is the revaluation. Then if you say 2.8 minus 20,061111, what do we get there? We get something about 738,889. So this is this amount. This is the one that we can take back to our acquisition journal. Okay, sorry. Here, when you said machinery, we have revalued machinery, refer to working one. This is also important, guys, so that the marker will know where does 738, where is it coming from. After you've calculated this figure again, there is also the deferred tax implication, but at what percentage? 35%, is it? Because this machinery, it is not off. Remember our income tax, we have got those that qualifies for income tax allowances, as well as those that apply or that qualify for CGT. But then after you calculated this, you get whatever amount you get from here. Then what else do we have there? Oh, okay. The next important question, or the next important aspect that you are going to calculate, is investment in Tangana. Okay, so then we can do another calculations again to see how much does Planet pay for the acquisition of 60% shareholding in Tangana. So the first port of call here, we have been talking about investment. This is our working number. Our working number 2, investment in Tangana. Okay. So with regards to investment in Tangana, we have got cash, is it? We have been told that on the date of acquisition, Planet World paid how much? Let us see. Retained earnings paid in cash. They paid 546,92600 Tanzanian shillings. But we have been also told about the purchase consideration, the total purchase price. We have been told that it is how much? If the total purchase consideration, it is 820,389.5 Tanzanian shillings, is it? But remember, during our reading time or during our analysis of the scenario, we have deduced that there's also an element of a deferred income in as far as our total purchase consideration it is concerned. But we have also been told about the contingent consideration of, so contingent consideration, which I'm going to term as CC, of how much? 275 Tanzanian shillings. So what it means, how much is our deferred consideration? So we are now saying the difference between 820,389.5 minus this, minus this, minus this. The remainder that we are going to find here, that's the amount of deferred consideration. So let me quickly do my calculations here. If I do my calculations, I'm getting 273,188.2. But another important aspect that you're supposed to have deduced. This 273,188,000.2, it is going to be paid on the 28th of February 2020. So, what does this mean? What does this mean? You are now supposed to calculate the present value of that purchase consideration. So, our N, it is equals to how many months? So we are saying from 1 August 107 2018 to 28 February 02 2020. How many months are there? Or how many years are there? Let me try to use my financial calculator. So 1 July 2018, then another date 28 February 02 2020. So I want to calculate the number of, okay, I'm getting 607. Let me see, divided by 12, what do I get? All right. So if you can calculate the number of months between these two, because we are saying from 1 July 2018 to 31 December 2018, we get how many months? We get 6 months, is it? Plus then the entire of 2019, is it? Plus 12. Then 2019, then we are now in 2020 plus 2. We got how many? 6 plus 18, we got 20 months, is it? So in other words, we have got 20 months, or alternatively, you can express 20 months in what? In years. So 20 divided by 2, we might get 1.67 years, is it? So our FV, we have got our FV is 273,188.5, is it? Do you have any PMTs? 0, is it? We have been told of R, the pre-tax one, which is 9%, if I'm not mistaken. Yes, that 9%, is it? And this was, okay, was determined to be 9%. So our next duty, it is to compute PV. So if you can do your calculations, my calculator is giving me 236,446.94. So for the purpose of calculating how much was the purchase consideration, we are going to say the cash that we receive plus the contingent consideration plus the deferred consideration, which is this one. So after we have calculated that, as per my calculations, investment in, okay, let me, investment in this, whereby we are going to say 236,444 plus 694. We then add this to 275, the purchase consideration, plus what was the cash that was paid on the date of acquisition, plus 546,926.3. So after you add this, so in other words, this one plus the present value that you have calculated is 236 4444 694 plus the 275 plus this one. Then if my calculator is right, I get something about 547,438,438. So that was the total amount that Planet pays when it comes to the acquisition of Tangana. So in my investment in Tangana in Tanzanian shillings was how much? Was 547,438,438. So with regards to this required, this is what we think were the most critical areas that we are supposed to have picked up. Like one, the revaluation of machinery, which proved to be a bit tricky, especially taking into account that we have been given the residual value as well as the revaluation that has taken place. So we thought it was something that was tricky to make sure that you also need to deduct the residual value at the end when you are computing the carrying amount. Then the land as well, and the most critical aspect or the most critical part was on which percentage to use, as well as the revaluation of machinery as well. Then the computation of the purchase consideration, how much was the investment in Tangana as well. And what happened to be the most critical or the most tricky part there was the aspect of deferred consideration. It wasn't clear because this is a slightly different scenario from the previous one that most of us we were used to, whereby you are told that deferred consideration of how much is going to be paid after this. I think that one, if that was the case, it was going to be a straightforward calculation. So in as far as your journals were concerned, you also have to calculate what is the NCI's share. So for the purpose of computing NCI, it's easy. So we are going to say the share capital plus retained earnings plus the revaluation and upward revaluation of land less the tax implication thereof plus an upward revaluation of machinery less the tax implication that follows there. Then you multiply that one by 40% for you to get the NCI. After you got that, you'll be in position to, now I'm not going to compute the journal entries for you because that one it's clearly straightforward, and we expect all of you to be in position to compute that journal entry. After you've computed that, you are going to get either goodwill or bargain purchase. So ladies and gentlemen, thank you so much for being part and parcel of this discussion. Should you have any questions or queries pertaining this and any other subjects, please feel free to get in touch with us. I wish you all the best.